There is a strange reality about crypto. Millions of people enter the market hoping to build wealth. They buy Bitcoin. They discover Ethereum. They hear about the next big altcoin. They watch influencers talking about the next 100x opportunity. And yet, many of them eventually leave the market with less money than they started with. So what goes wrong? Is crypto simply too risky? Are successful investors just lucky? Or is there a completely different reason why so many people lose money? The answer has very little to do with finding the perfect coin, and much more to do with human behavior. Welcome to BlockAlpha. Today, we're going to look at the biggest mistakes crypto investors make, why those mistakes are so common, and what a more disciplined approach can look like. Let's start with the first mistake: buying because the price is going up. This sounds obvious, but it is one of the most powerful forces in financial markets. Imagine Bitcoin has been rising for several weeks. Your friends are talking about it. Social media is filled with screenshots of profits. News headlines are becoming more optimistic. Suddenly, you feel like you're missing something. So you buy. Not because you studied the asset, not because you created an investment plan, but because everyone around you seems to be making money. Then, the market falls. Fear appears. The same people who were celebrating a few days earlier start talking about selling. And now you're faced with a difficult decision. Do you hold? Do you sell? Do you buy more? Without a plan, emotions usually make that decision for you. This is the first major lesson. A good investment decision made for the wrong reason can still become a bad decision. The second mistake is chasing the next big thing. Crypto is particularly good at creating excitement. Every market cycle produces new narratives. Artificial intelligence, meme coins, DeFi, Layer 2 networks, gaming, real-world assets, and dozens of other themes. Some of these technologies can become genuinely important, but that doesn't mean every token associated with them will succeed. This distinction is extremely important. A good technology does not automatically make a good investment. A popular project does not automatically mean its token is undervalued. And a coin that has already risen dramatically does not become safer simply because people are talking about it everywhere. Investors often confuse popularity with value. The third mistake is putting too much money into one trade. Imagine someone has $10,000. They become convinced that one cryptocurrency is about to explode. So they invest $8,000. Maybe the investment works. But what happens if it doesn't? A single mistake can destroy years of savings. Risk management exists for exactly this reason. You don't need every investment to succeed. You need your failures to be survivable. This is one of the biggest differences between speculation and disciplined investing. Speculation asks, how much can I make? Discipline asks, how much can I afford to lose? That second question is much less exciting, but it can be much more important. The fourth mistake is using leverage without understanding it. Leverage can make a small market movement produce a much larger gain, but it can also magnify losses. A trader may correctly predict the long-term direction of Bitcoin and still lose money because the market moved against the position temporarily. This is why leverage can be particularly dangerous for inexperienced investors. You don't just need to be right. You need to be right at the right time. And markets don't care about your timing. The fifth mistake is trying to predict the exact top and bottom. People constantly ask, is Bitcoin going to crash tomorrow? Is this the bottom? Is this the next bull market? Should I sell now? The problem is that nobody knows the future with certainty. Professional investors don't have a crystal ball. They manage probabilities. They build strategies that can survive different scenarios. That mindset is much healthier than trying to predict every single move. The sixth mistake is ignoring the difference between an asset and a narrative. Crypto is full of stories. A project might have an incredible roadmap. A famous investor might support it. A popular influencer might say it will change the world. But none of those things guarantee that the token will increase in value. Investors need to separate the story from the numbers. What problem does the project solve? Who actually uses it? How is the token used? How much supply exists? Who controls that supply? What are the risks? Those questions are less exciting than a price prediction, but they're much more useful. The seventh mistake is having no exit strategy. Some investors spend hours deciding what to buy, and almost no time deciding what would make them sell. That is backwards. Before entering an investment, you should understand what would make your original thesis wrong. If your reason for buying disappears, your position may need to change. This doesn't mean selling every time the market falls. It means knowing why you own something. The eighth mistake is confusing volatility with opportunity. A falling price can create an opportunity, but a falling price can also be a warning. There is an enormous difference between buying an asset because it became cheaper and buying it because its underlying fundamentals remain attractive. A 50% decline doesn't automatically mean something is undervalued. It may simply mean the market has discovered information you didn't know. That is why research matters. And there is another mistake that might be the most important of all: trying to get rich too quickly. Crypto attracts people because of its extraordinary historical returns, but those returns can create unrealistic expectations. Someone sees a story about an investor turning a few $1,000s into millions and starts believing they can reproduce the same result immediately. That mindset can lead to excessive risk, and excessive risk can turn an investment account into a gambling account. Building wealth usually requires something much less exciting: time, consistency, risk management, patience, and the ability to survive bad decisions. Think about it this way: you don't need to find the next Bitcoin. You don't need to predict every market cycle. You don't need to become a professional trader. You need a process that prevents one mistake from destroying everything. That process could include diversification, position sizing, a long-term time horizon, independent research, and a clear understanding of your own risk tolerance. The crypto market will continue changing. New technologies will appear. Old projects will disappear. Regulations will evolve. Institutions will enter the market. And new narratives will emerge. But human psychology will remain remarkably consistent. Fear will still create panic. Greed will still create bubbles. And investors will still chase performance after the biggest moves have already happened. That is why the most valuable advantage in crypto may not be information. It may be discipline. Because when everyone else is reacting emotionally, the person with a plan has something extremely valuable: time. So the next time you see a cryptocurrency exploding across social media, don't immediately ask, "How much money can I make?" Ask, "What am I actually buying? Why am I buying it? What could make me wrong? And how much am I willing to lose?" Those questions won't make you sound exciting on social media, but they could help you become a much more intelligent investor. Crypto is still one of the most dynamic areas of finance, and that means the opportunities can be enormous, but so can the risks. The goal isn't to eliminate risk. The goal is to understand it. And if you can control your emotions, manage your risk, and think beyond the next few days, you already have an advantage over many people entering the market. This is BlockAlpha. We don't chase hype. We decode crypto. And we help you understand the forces shaping the future of money. Subscribe to BlockAlpha for more crypto analysis, market stories, and financial education. I'll see you in the next video.